Welcome to the fifth lecture on M&A entitled M&A Process. And by now you should have realised that there is not a simple link between strategy and performance, and that process plays an important role. And that's why we'll now spend some time looking at the M&A process. In this lecture we'll cover the following topics. Firstly, what is the acquisition process? Secondly, who are the people that are involved? Thirdly, the stages of the M&A process, and this will be a relatively simplified version. Fourthly, the role of due diligence, its scope, its strengths and its weaknesses. And then finally, the dangers of over-focusing on just doing the deal. This is a simplified model of the acquisition process. So if we go from the left-hand side of the slide towards the right, on the left-hand side there's a basic idea around why the company is intending to make an acquisition. And this obviously should match with an overall strategy. The next box is then about how do we justify specifically an acquisition for the company, as opposed perhaps to alternatives like joint ventures or strategic alliances. Having justified it and tried to find a target, you then move into negotiating with the target in order to conclude a deal. And if those negotiations are successful, we then move towards the acquisition integration, where we try to put the two companies together, and hopefully these lead to improved results overall for the acquirer. So this is the overall process, but it has a number of features that I think you need to be aware of. So first of all, on the left-hand side, this is around a decision-making process of trying to decide, is this the right approach to expansion or growth? Should it be an acquisition? And if it is an acquisition, which target should we go for? And then how will we approach it, the target, in order to do a deal? And on the right-hand side, it's more about integration process problems, how we put companies together in order to achieve results. Now, above the process, you'll see three bullet points around momentum, fragmentation and reductionism. These are problems that are inherent in the process. The first one is momentum. In order to achieve a deal, you normally have to have some sort of momentum, which means pressure to get the deal done. If you don't have pressure, then the tendency or the likelihood is that the deal never gets done because the world changes, there's a lot of complexity, and things just get in the way. Now, this momentum can be achieved through a variety of devices. The most powerful one, of course, is institutional, where in particular countries there are actually formalized timescales within which deals have to be done. If you're a company that's listed on a stock market, in the UK, for instance, you have just 60 days in which to do a deal. So that's obviously time pressure. But there's also pressure from stakeholders, from top management teams, and indeed the CEOs of both the acquirer and the target will be keen to get something done because it's distracting them from the day-to-day work they have to do running their own businesses. And they just can't afford to be constantly tied up in long-term negotiations. The second point is fragmentation. Now, because deals are very complex, we're dealing with every aspect of a company. What tends to happen is we break it down to try and make it manageable by focusing on various pieces of the transaction. So, for instance, we look very carefully at the report and accounts. We look at the legal contracts. We might look at other issues such as personnel and so forth. Now, the fragmentation makes a complex process more manageable, but there are costs to that, which assumes that those pieces are actually all joined together, so we have a good holistic sense, by which I mean a good overview of all the details in one piece. The reality, unfortunately, is not so true. We often just end up focusing on certain pieces and not the whole picture, and that can lead things to be forgotten or overlooked. But unfortunately, they come back very much in the integration process. An example would be, for instance, culture. Because it's hard to quantify, it tends not to be considered much in the negotiations. But in the integration process, if you have big differences in culture, you may end up with big problems. And reductionism, which is the third one, is about oversimplification. Again, because it's highly complicated with lots of interconnected parts, we tend to try and simplify, again to make it manageable and also to make it accurate. Now, from a professional advisor point of view, we try to give a very good service, and so we tend to focus on the pieces that we wish to get right, so that should the client be unhappy afterwards, they can't sue us for a bad job. So not surprisingly, we focus on tangible things like reporting accounts and hard numbers and legal contracts, and we tend to ignore some of the more complex, softer issues which are hard to pin down and would perhaps be a grounds for lawsuit later on. So through that reductionism, we're not necessarily getting a good perspective on the entire business that we're buying, and I'll give you some examples of that later on. Another point in the diagram, you'll notice two vertical lines between negotiation and acquisition integration. This is something I discovered in my research years ago, was that the people doing the negotiations, namely the chief executive and the financial director, are often not the people who then manage the integration process. And often the communication between the acquirer, CEO, and the finance director, the communication with their own operations people, can actually be very poor indeed, such that they may say, we've bought the company and we expect a 20% return in the first year, as being the only instructions that you need to then go and integrate and run a target company. So that poor communication, lack of detail, is something of a wall, which means integrations can go in a different way to perhaps that intended in the negotiations. There's a nice quotation at the bottom from The Economist, which is a UK business magazine of quite high standing. It says, "Why do so many mergers miss the mark?" And of course they mean mergers and acquisitions. "What seems to link most mergers that fail is the acquirer's obsession with the deal itself, coupled with too little attention to what happens next." In other words, we do get very, very focused, myopic even, and focused on getting that deal done. And in that stress, we tend to forget what comes next, namely the integration. So there are lots of problems that are caused by the M&A process, and here's a list of a few of them. The first one we talked about a little bit, which is time pressure to get the deal done. And this is a real problem because it means you can't be very thorough in your investigation. And let's face it, companies are complicated. We tend to only use the most senior people because of time pressure and also the need to be secret. You don't necessarily want your competitors knowing what you're doing until you announce. And of course, momentum, which I mentioned earlier. Secondly, what we call cognitive distortions. These are human conditions that we tend to perceive and distort the world around us in different ways. One might be being optimistic. We feel the world will not wait for us, so we have to do the deal. We tend to overestimate the gains that we're going to achieve from the deal, and we tend to underestimate future problems. And as I mentioned before, the problem of fear. We feel perhaps if we don't do the deal, someone might acquire us. And there are many examples. In the UK, the Bank of Scotland wanted to take over the Halifax because they felt that they might be acquired themselves. The third one is that markets, the stock markets, and advisors such as merchant bankers, investment banks, lawyers and so forth are all transaction oriented. What does that mean? It means they just want to get the deal done because their fees are dependent on that transaction. They don't get fees for what happens afterwards. So as it says, the fees are loaded towards successful conclusions. And that's why advisors tend to be structured in terms of cross-sections. In other words, they tend to focus on getting the deal done rather than looking across the entire process from the original idea through to integration and results. Now, unfortunately for companies, we tend to listen to our advisors, not realizing that perhaps they have a different payoff structure to our own. Then the fourth one is that stakeholders fear uncertainty, by which we mean investors, customers, suppliers, management teams, employees and regulators. People want to know what's going to happen so they can make decisions. Do we buy more stock or do we sell it? If you're a supplier, can we supply to you, or are the terms and conditions going to change? Or should we find an alternative company to supply to? From an employee point of view, well, am I going to have a job after this is over? Should I be looking somewhere else? Uncertainty is a damaging thing, and we'll talk more about this. It's a problem because it can destabilize critical relationships, and companies have and are dependent upon critical relationships. And of course, investors want to make sure they're going to get returns on their investment and that their confidence is justified. So there's a lot of effort to reduce uncertainty amongst stakeholders. And then finally, as you're guessing, actually the process itself, managing the process itself, is problematic. So let's have a quick look at who might be involved in the M&A process. So I've kept the simple version below, which is framing the strategy, identifying a target, transacting the deal, and implementing the acquisition. And I'd like you to think about who do you think would be involved outside of the companies, so not the internal management team and so on, but outside both companies, who's going to be involved in the M&A process. And maybe spend 3 or 4 minutes thinking about this before you go to the next slide. So what we have here is a simplified version of all the stakeholders that are involved in a mergers and acquisition. So we have our process at the bottom, the framing, the strategy, identifying the target, and so on. And then around you can see a big cloud of important stakeholders. And obviously these will vary to some extent depending on whether you have a public deal or a private deal, whether you're going cross-border or not, and also to some extent the size and complexity of the companies involved. So if we look first of all at the framing of the strategy, industry contacts are going to be important, letting you know perhaps potential deals and so forth. You might draw on strategy consultants, companies like McKinsey's, the Boston Consulting Group, LEK, Booz Allen, and so on, to give you some strategic advice around growth and acquisitions in general. You may find that there are sector-specific M&A advisors, what we call M&A boutiques, who have high specialization in just your industry sector to help give you advice. And we mustn't forget, around the outside, we have government and governmental agencies who are going to be important in sort of shaping the terrain and the territory, and also in terms of what you can and can't do. So the regulators in those terms. As we move to identifying the target, at the top we have institutional investors, pension funds, insurance companies, investment companies, bank trust departments, mutual funds, and so on. And they can be big stakeholders in both the acquirer but also the target company. And they can directly influence company decisions and top company boards. In a deal, you'll find that often investment bankers are going to have a very central role. They tend to be the main mediators between medium to large deals and all the other stakeholders. And they'll be involved in strategies for deals and tactics. They'll be screening companies to be acquired. They'll be involved in contacting those companies, negotiations, valuation, structuring deals. And they'll be liaising on your behalf with the lenders, the financial lenders to your companies, such as banks and venture capitalists, investment banks, and so on. They'll be liaising with accountants who will be looking at the financial due diligence, the deal structuring, tax structure. They'll be dealing with lawyers who will be looking at the ins and outs of particular M&A deals, corporate law, employee benefits, real estate, antitrust, securities, intellectual property and litigation. They'll be dealing with PR firms, that's public relation firms, because particularly with larger deals and publicly listed companies, how you project that deal to the media is going to be very, very important. And using advisors, PR firms, is good practice. You might even draw on private investigators if you're suspicious about any issues to do with the company you're buying. So what are the motives of the target management team? Are they honest, for instance? You'll want to be sure about financial dealings or things that might come to damage or discredit the acquirer. there may be some issues with the way they manufacture goods, for instance, in another country, using unethical principles that could cause you problem if it got into the media. And of course that will take us through identifying the target on the yellow bar at the bottom and transacting the deal. And of course we're going to have to engage often with regulatory authorities, which are in the right hand side. In the UK we call it a takeover panel. There are different regulator names depending on the countries, stock exchanges, central banks like the Bank of England, and depending on the size, if it's a big deal, you'll be dealing with national governments, and also in European countries you'll be dealing with the European Union regulators. In large deals, for instance, when there was an attempt to take over ABN AMRO, the acquirer was having to consult with over 200 regulators at the same time. So this can be immensely complicated, and these regulators have different standards and they don't all agree, and there can be conflicts. So this can be very difficult going cross-border, or particularly if you have a business that's in many countries. And then also involved can be pivotal in the deal itself are arbitrages, which are on the bottom there, as they will take positions and stakes in order to maximize their benefits from your transaction. And on the far right hand side we have implementing the acquisition, and here often companies will use a wide range of post-acquisition consultants for specialist tasks like human resource integration or IT alignment or operations restructuring. Occasionally there are generalists, large companies like PricewaterhouseCoopers, Ernst & Young. These might be involved in the whole process, but equally you might decide to use specialists. So hopefully you can see here that even in this cut down version, there can be a lot of major stakeholders involved in trying to get acquisitions done and for them to succeed. So now let's move on to a more elaborate version of the M&A process, the stage model. So I'll go again from the left to the right. So we have our corporate strategic plan, which will be around about growth, and we'll be thinking that maybe acquisitions are the right way to go. The next step is to make sure that the company is prepared to make an acquisition. So in other words, do they have access to the funding, whether it's equity or debt, to the shares high enough value, for instance, or can they raise funding? And do they have the management capacity to take on managing an acquired company? And also perhaps there may be other elements of capacity or capability that they need in order to integrate the target. There's then a search for targets, and here you'll probably use advisors such as investment banks or maybe accountants or even lawyers to start screening and searching for targets. And if you narrow that down to a particular target, you'll then engage with a first contact. Now this is often very sensitive, and so you may prefer to conduct this through a third party rather than have the two CEOs meeting. Obviously, if people see two chief executives talking, then rumours may start to fly around, particularly in listed companies, and that can affect share prices. So you may ask your investment banker or perhaps even an accountant or some other third party to see if there's interest in the target to begin any form of negotiation and investigation. And here you may put together something called a heads of agreement or a letter of intent, which is really just a simple document that says that for a limited period of time that you will talk to each other in confidence and obviously not leak each other's secrets to competitors or even steal them for yourselves. If that's signed, you'll then move into a negotiation phase, which includes due diligence. Now, prior to the negotiation, you will have already had some idea of what the company might be worth, but now you can collect information through due diligence to refine that valuation and structure your deal and perform a much more detailed investigation. This assumes, of course, that the target company is happy to allow you to ask lots of detailed questions. And this allows you to adjust your deal terms and your valuation, which obviously you'll then present to the target company to see if they'll agree. And if they do agree, of course, we can move forwards. If they don't agree, then if you have time, you might make some adjustments, or you may just have to walk away. Ideally, you'll then start to plan to integrate before you have a closing ceremony where the ownership transfers to the acquirer. And then after the closing ceremony, the company is yours, and you can begin with integration, which is quite a complex process. And hopefully this will lead then to successful evaluation later on. Now, running above this stage model, I just wanted to put two rather, they're not very attractive arrows, but that's the whole point, is to remind you of them. The top yellow one, called macro environmental drivers, is really to remind you that throughout this process, the world is changing. And so where you started off in this process, the world may have changed quite a lot by the time you get to your evaluation. How long might this take? Well, you could be searching for targets for, quite some time. It can range from something opportunistic where an advisor or an industry contact suggests something and you're immediately into thinking about the acquisition and planning. So that could be literally weeks. Or it could be years where you're looking for the right target. And I think Lafarge have been planning the Blue Circle deal for nearly 2 years before they actually launched a hostile deal. Of course, we then have the negotiations, and the regulator may impose a limit here if it's a public company of, say, 60 days. So that may actually be quite a short process. It is possible to negotiate, then walk away and then come back again. So these things could be protracted, but often that's not the case. And then you get your closing, which could be a period of time, a month, 3 months, something like that. And then we're into integration. And integration can last from 60 days to 7 or 8 years. It can be an extensive period of time. And that's why changing in the context, the macro environmental drivers, really matters, because very few countries are absolutely stable and the economies are absolutely stable over such a long period of time. So things will change. And the other arrow is a green one on the left-hand side, which is path dependency. And this says that we all come from particular histories to get to this point, and they do affect the way we see the world and the way that we react. And this may be a form of unconscious bias. So an example here is when BMW took over the Rover car company in the UK. Now, as I'm sure you probably know, we were adversaries during the Second World War, and both sides remembered this. And so when BMW was taking over Rover, which was the last large volume car manufacturer in the UK, they were extremely worried about the previous history and thought they might get a lot of resistance from UK workers being controlled by a German car giant. So when they came to the UK, having acquired Rover, they decided to tread very, very carefully and therefore not make many changes at all to try and make sure everyone was happy and they would let things just continue. Now, unfortunately, in the Rover car company, things were not great. There was real problems in the supply chain. There was big industrial unsettlement, or people were angry and cross, and it wasn't working well, which is why the company was vulnerable and losing a lot of money. And from the British point of view, they realised that BMW is a great car company that makes great cars. And so they were very pleased that they would be bringing that expertise and knowledge to the UK to help Rover make a far superior car and to improve the fortunes of the company in the future. So they were expecting BMW to come in and impose far better working practices to allow them to make superior cars. So they were very confused when the Germans arrived and basically did very little indeed. And so things just deteriorated. And unfortunately for BMW, Rover started losing vast amounts of money, hundreds of millions. After a while, the Germans realised the problem and started to put in processes and practices, which eventually did result in a better car. But by then they'd lost so much money they had to sell the company. And they sold it for literally just £1. Not much return in 800 million expenditure. So path dependency influences the way we think about deals, and we shouldn't forget our history and our past and our cultures when we're actually negotiating and integrating. So I shall go through these aspects of due diligence fairly quickly. Essentially, you have a search criteria, and you start off thinking about which geography do you want to be in, what industry do you want to be in, and obviously what sort of size of acquisition you're interested in as well. You're very lucky today that there is so much information online in terms of databases and so forth. And also there are a range of contacts that you can get hold of fairly easily, such as industry, financial advisors, brokers, accountants, lawyers, government, and so on. So there's a lot of information out there these days about potential acquisition targets. And then you'll carry out some sort of crude screening, such as the target profitability, its leverage, in other words, the amount of debt it's got, its market share, what markets it's in, its product lines, and of course, is it even available to be acquired? The most important thing to remember in this process is what makes for a good target. So just because a target is cheap or available does not mean it's the right target for you. You know yourself, if you're walking down the high street and you see a jacket that's at half price or 70% discount, a really great leather jacket, it doesn't mean it's right for you because it might simply be the wrong size, in which case it's unusable. So does the target maintain or enhance the acquirer's SCA, by which I mean sustainable competitive advantage? In other words, is this target going to help you do more than you could before, or do things better or faster than you could before? You have to be very clear on this. In what way does the target improve your competitive position in your various markets and with your various customers? And therefore it needs to fit or extend your capabilities and add usefully to the resource base and not be a drag on your time and effort. You do not want an acquisition which is a drain on resources in terms of finance and management time, or compromises or damages your strategic or sustainable competitive advantage. So in other words, beware of the great acquisition opportunity that is a great opportunity for somebody else. So what are the generic qualities of a good target? Well, first of all, it does need to be available for purchase. And on the right hand side here, I talk about something called the lemon problem, which is often companies that are for sale because they're not good companies. They may be dressed up to look as if they're good, but actually they're not, and we call that a lemon problem. Secondly, you don't want something that's too expensive. On the right hand side, we call this the premium problem. The two issues with this, one is if you pay too high a price, you won't be able to get a return on your investment because you will have actually given it all away to the target shareholders. And also there's a risk that you end up leveraging yourself or putting yourself into such high debt that you can't fund the acquisition properly going forwards. Thirdly, relative size matters. You do want to avoid acquiring firms which are really too small. And we talked about this before, because it can actually end up distracting you in terms of the amount of effort required for integration. Or alternatively, of course, people will be resentful if you start giving all that effort and not looking at other things which seem to be bigger and more important. Avoid large targets because they can end up with arm wrestling. So if the company that you're acquiring is the same size or bigger than you could end up with problems in integration, political problems and power problems. And the final point there is avoid acquiring too rapidly because you might end up with indigestion. You may not actually be able to cope with getting lots of different cultures and systems and processes coming in that you don't have time to homogenize and make similar. In terms of market share, we've talked about this before. Try to make sure that you get something that has a good market share and strong customer base. Otherwise, you may just be moving into a poor competitive position. And hopefully the target company is going to be well run in that it's financially healthy and robust. As it says, poor financial health will damage your wealth. Loss-making targets often fare badly. And I've said before, with cross-border deals, it's good to buy a strong local presence. And there's a nice McKinsey study on that. Relatedness, I've mentioned before, but it's worth restating. Just because you're buying in your own industry does not mean it's going to be a successful deal. Whilst relatedness gives you much greater synergy possibilities, it also gives you much higher integration risk because of complexity. So don't assume that those are the best types of deal. So to summarize what makes a good target, it should complement your competitive advantage, that's strategic fit. It needs to be well managed in terms of good financial health, good systems and procedures, has to be well run. The structure and culture are compatible with the parent or the acquirer, in other words, good organizational and cultural fit. That the target management wants a friendly deal, because often with hostile deals you get to very negative situations. You want a good price, don't overpay, and from the due diligence you want evidence that the sources of value are certain to remain after you've closed the deal. If that value consists of critical employees, it's a disaster if they suddenly decide to leave because you've got nothing. And it may be that this is quite a useful set of criteria to judge or analyse an acquisition that you might want to look at. Does it really deal with all of those points well? So right at the beginning of a due diligence, you're often going to have some sort of agreement with the target company, the CEO, to make sure that you can actually work together for a limited period of time with a certain amount of security about information that may be gained as a result of your due diligence exercise. And here we call it either a letter of intent or heads of agreement. You might have a slightly different name for it. It's confidential and it's mutually binding, and it sets out the principal areas of agreement, terms and conditions, non-competition clauses, and it's about access to information. Depending which country you're in, it could be legally binding, so just be careful. In some countries, it's just simply a statement of honour, if you like, or trust. In other countries, it's actually legally binding, and you could be sued if you breach it or break the terms of the agreement. Now, before we get into some of the detail around due diligence, let's just ask why we have to have it at all. So if we go back to our simple version of the acquisition process, and you'll see in the middle we have the wall, which I mentioned before. Above it is a term which says information asymmetry, and this is the main reason for due diligence. What it means is you just don't know, as the acquirer, you don't know everything about the target company. So there's an information asymmetry. And what you're attempting to do is to reduce that information asymmetry through due diligence. So if we think about it in real terms, if you're going to buy a car, for instance, a second-hand car as opposed to a new one, you would probably want to at least sit in it to see if it's comfortable, and probably even drive it around a bit to make sure it sort of works. It's unlikely you would just turn up and hand over your hard-earned money and walk off, or hopefully walk off with the car. So you're trying to do a bit of investigation and asking questions like how many miles has it done, how reliable is it, and so forth, how often has it been serviced, to try and reduce the risk to you that this company is perhaps not all that it appears to be. And that's why we have due diligence. And as the quotes below illustrate, it says, if knowledge seems expensive, because your due diligence experts are not going to be free, try ignorance. And another quote which is quite useful, we always have to make decisions based on imperfect information, but some of the risks can be reduced by improving our level of a priori knowledge. In other words, through due diligence, we can reduce the information gap. Now, in terms of knowledge, there was a very famous speech by Donald Rumsfeld, the Department of Defense in the USA, which I put on the right-hand side, about knowledge, and he called it the unknown. And I'll read that to you. As we know, there are known knowns. There are things we know we know. We also know there are known unknowns. That is to say, we know there are some things we do not know. But there are also unknown unknowns. The ones we don't know, we don't know. And of course, all of those are absolutely true. And we are worried about the things we don't know. But he's actually missed something there as well, which is we don't know what we know. And this is really about our core assumptions that we never question, a little bit like the path dependency point I made in a previous slide. And we often do things not questioning our own knowledge. So if we look at the left-hand side of the slide, I'll explain that a bit more for due diligence. We know what we know. So for instance, as an acquirer, we know how to deliver on contracts. That's what we do. We know what we don't know. We don't know how they deliver on their contracts. But because we have expertise in contracts, we can look at that and we can work it out, and therefore we can plan for how we might deal with that difference. The third one is we don't know what we don't know. So no company is perfect. There are always problems, what we might call skeletons in the closet or in the cupboard. We know there's going to be difficulties, but we have absolutely no idea what they might look like and where they are. And the only thing you can do is hope the due diligence might find some of these, and also plan maybe some contingencies or prepare for some surprises. There isn't such a thing as a perfect deal. And then the final one is we don't know what we know, and that's about our assumptions about how we do things. And it's useful, I think, to reflect on, the specific ways we do things which we take as being normal, but actually could be extremely different to what's happening in the target company, particularly if we go cross-border. So to illustrate this with a diagram, we have two charts. The one on the left-hand side, it's very stylized. The one on the left-hand side is basically giving equal importance to the four areas about what we know and what we don't know. And in terms of what we know, that's a quarter of the circle, and what we don't know is another quarter. So we're fairly well fixed for half this circle, but the other half we really have no idea. And essentially through due diligence, we're trying to shift those proportions to the ones on the right-hand side, where actually here we end up knowing maybe a good 3/4, possibly even 80%. We know what we have to do. But let's remember, there's always going to be stuff that you don't know, that you just never will find. So as it says at the bottom, you will never know everything, but you may be able to reduce some of the risks. And that's really all you can expect from due diligence. It cannot be perfect. They don't have unlimited time and resources and unlimited access to find out everything. It can't be done. So to give you some examples where due diligence wasn't properly carried out, leading to disastrous deals, a famous one was by Ferranti, which was a UK sophisticated radar producer and manufacturer, a very high quality engineer. But they were quite small and they wanted an international market to move into. So they bought an American company called International Signal Controls, which is hugely profitable. But they were very secretive about their customers. They would not let Ferranti know who the customers were. So Ferranti bought the business on trust. And as soon as they did that, they realized that International Signal Controls was sending lots of weapons to clandestine groups, which of course is completely unethical for Ferranti to do that. And therefore they couldn't make those sales, having spent a fortune on buying International Signal Controls, mostly funded through debt. As a result, the cash flow stopped, they couldn't service the debt payments, and Ferranti and International Signal Controls are now history as they both went into bankruptcy. British and Commonwealth was quite a nice bank, a small investment bank, and for reasons that I don't understand, they bought an American computer leasing company called Atlantic Leasing Computers. Now this is a good case of them not knowing what they knew. So operating in the UK, they understood the computer leasing business, and essentially there you deliver the contract, if you like, and at the end of the leasing period you receive payment. What they hadn't realised was in America it's completely the other way around. You receive payment up front, then you deliver on the contracts. So when they bought the business, they had completely misvalued it and hadn't realised they were taking on a huge amount of contracting liabilities, having already paid or received the money for those services. And they couldn't sustain that. And again, both companies went into liquidation. Another example, in Australia, BHP, Broken Hill Proprietary, is one of the world's largest miners. It bought a company in the US called Magma Copper for Australian dollars 3.2 billion to become the world's second largest copper producer. They did this in the comfort of some offices in a large city, New York, I think. They didn't bother going out to visit Magma Copper. They didn't see anything. But when they took ownership, they suddenly realised that this was based in an area with no local supply of copper ore, and there was no port to ship the ore in, and the transport links were extremely bad. And within 3 years, the whole thing had become unviable. Costs rose and the copper market fell, leading BHP to have to write down everything by 4.2 billion, and they lost 2,630 jobs. Another example, MCI, British Telecommunications Company, bought Embratel in Brazil for $2.3 billion. As soon as the deal was closed, the Brazilian government then demanded tax from them for 500 million. That affects your discounted cash flow quite a lot. More recently, Hewlett-Packard, American company, bought Autonomy, a UK company, and then they said there was lots of mistakes with the accounting, which made them misvalue it, and they had to write down this deal by $8.8 billion. It was $11 billion deal, so it's an $8.8 billion write down, and they are still in lawsuits over this. The UK would say that in fact it was because Hewlett-Packard did bad due diligence and that they were in fact honest. At the moment, nobody knows the answer to that. And I mentioned to you already BMW buying Rover, but cultural differences meant inactivity, and so whilst they bought it for £800 million, they sold it for just £10 to a management buyout team. And I realised, of course, in the previous slide I said to you they sold it for £1. I'm sorry for that. It's in fact £10, about the price of a cappuccino and a burger maybe. So due diligence matters, and it aims to bridge the strategic review and the completion of the deal, and you're trying to understand as much as possible about the target firm. The primary reasons are to identify and confirm the sources of value, making sure you're asking the right questions. You're also trying to find out what are the fatal flaws, we might call them black holes, and can we reduce the risk of this purchase. And also, good due diligence will identify key negotiating issues which you can use as levers to influence the price and also to build trust with the target company. It's there to protect the acquirer rather than the acquired, and to provide comfort to the management team and shareholders, to assure them the bid is sensible, that all risks and problems have been uncovered, and also to identify those areas where the acquirer needs protection against certain risks. And here we use things called warranties and indemnities, which are legal terms that will appear in a legal contract, where you try to get the target company management team to warrant that things are true if you can't inspect them or assess them for yourselves, and also to indemnify you, which means make you a payment should things not turn out as you expect. And also, in theory, due diligence is to protect the acquirer management team from the winner's curse, which is they get very excited about making a deal. It's good for their reputation and so forth. And that might mean they get overconfident and end up paying far too much for the target if it ends up in some sort of bidding war. My experience is that due diligence isn't necessarily very good at that, but sometimes it can help. So traditionally, due diligence was carried out by accountants and lawyers looking at accounting issues, tax, contracts, legal liability. Better acquirers tend to widen the scope, and they tend to realise that good due diligence will help them effectively manage the target better. And therefore, due diligence should cover all of the following, which is commercial issues, operational issues, accounting, finance and tax, of course, legal issues, human resources, organisational issues in terms of structure, style, power, and information systems. And I would see those as being the minimum for due diligence. As I said before, you cannot look at everything. You have to prioritise information that's needed because you don't have unlimited time or access. So make sure you're asking the most important question. And the question is, what would be the key things? I'll let you just think about that for 30 seconds. Now, some of you will have said immediately the key things are accounting issues and legal issues. My answer is that it's not quite right. I think the key issues depend on what business you are and what you have to get right to make your business better. And they may not be things that are captured by the accounting or legal issues. So often accounting and legal issues are about reducing risk, but they may not give the emphasis that you need for your acquirer to get a good deal. So just be a little careful here. We're trying to make the acquirer a better company. Now, in terms of due diligence itself, let's talk about access and depth. Bear in mind, the target does not have to give you information. It's really dependent on how keen they are on doing a deal with you. And of course, if it's a hostile deal, they'll certainly not give you information if they can help it. They may even give you wrong information. So it's not a simple equation. Also, if it's a public company, there's a real problem with giving information to an acquirer, even if they're friends, because under law, if another bidder should come along, they'll have to disclose that information to them as well, even if they don't like those bidders. And a famous example in the UK was WPP, which is the world's largest advertising company, made a hostile bid for Taylor Nelson Sofra for £1 billion after they'd been talking for some while with a German bidder called GfK, who'd offered an attractive premium, a nil premium merger. Now, because Taylor Nelson Sofra liked GfK and wanted to do the deal, they revealed a lot of sensitive information about the company to GfK, which WPP then demanded at the 11th hour, and Taylor Nelson Sofra was forced to give them the information. This allowed WPP, of course, to know exactly what they were buying, and they were able to make a knockout bid of £1 billion, and they won the deal. The first thing WPP did was then to fire all of Taylor Nelson Sofra top management team because they said they were incompetent and they should have known this fact. So there are consequences for not knowing what you're allowed to do or not. The depth of access to data depends upon deal type. As I've suggested already, a friendly deal is going to be more open than a hostile one. But also, if you're buying a public company, publicly traded company, you'll generally have much better quality of information because they're regulated. But of course, they're likely also to be try to be less open. Particularly, of course, if the direct competitor is a bidder and if there's anticipation of an unwanted bidder. Private deals, you tend to get the extremes of both openness and closeness. The timing of access will also vary. Pre-deal access to internal information happens for friendly deals and in most private deals, but of course in hostile you're just not going to get the information, so essentially you'll just have to find out after you've bought the company, and of course that could lead to some unpleasant surprises. If it's a friendly deal, sometimes acquirers do engage in post-deal due diligence, but often they don't do that, and maybe that's a mistake. Maybe it's better to find out what you've really bought, even though it consumes a bit of time. There are many secondary sources of information which are readily available to bidders. The desk-based ones are obviously linked to the internet and include things like trade journals, brokers' reports, market reports, trade associations, corporate libraries, report and accounts, prospectuses, and so on. But you can also think laterally, and in one deal, KPMG, the large consulting and accounting group, hired to look after a particular target grocery company who was wanting to know whether there were synergies between itself and potential bidders. They ended up looking at an animal rights activist website which gave a very detailed picture of bidders' stores and their warehouse network. So whilst maybe it's not obvious to look at animal rights activist websites, in this case it gave them a lot of very useful information. So you should think more broadly, think laterally. Primary sources of information include, importantly, face-to-face meetings, and they're really the most valuable source of information. Of course, you do need to cross-check this, and you can end up talking to a lot of direct stakeholders, such as top management teams, both the current ones and the ones in the past. Former employees, of course, they really do know a lot, particularly about things like culture. Key customers, today's and ones in the past, as well as suppliers and competitors. Beyond the direct stakeholders, there are journalists who might cover the sector, industry observers, regulators and industry advisors who also know a great deal. And as I said once before, if there are potential reasons for concern, if you're worried about anything, you might consider private investigators as well. Inside of the acquirer, so although you may be the acquiring company, you may have people already inside your company that know something about the target company through their own informal networks, or maybe through trade shows they might have met people from that company or at conferences. So don't forget, there may be people in your organisation, if you're the acquirer, who know something about the target. Now, the target company will often provide you with a lot of information in good faith, and the purpose of due diligence is to test whether that information is true or not. So you'll use it to verify the figures, because they will show you historical performance. They'll give you data on markets, competitors, customers and so forth, and you need to make sure, of course, that these are accurate. You certainly need to be aware of what the accounting policies and practices are, because this is a way of distorting earnings and liabilities. And you also need to find out about the quality of the management information systems and previously audited figures. You're trying to provide confidence about the underlying performance of the target company. And of course, therefore, you will be looking at revenues, quality of assets, basis of liabilities, tax status, leases, insurance, and capital commitments. You'll also want comments on the management cash flow projections. You need to know both the method and the assumptions. And you'll be looking out for any potential distortions in figures. One common approach is to bring forward profits and delay costs, thus making the company seem a lot more profitable than it really is. Essentially, those carrying out financial due diligence are trying to work out what is the level of maintainable profit after the acquisition has taken place. As I mentioned before, there are many other areas of due diligence inquiry. If we look at the legal side, essentially they're trying to work out, is there a legal and legitimate title to the assets? In other words, the people who are selling you the company, do they really own it? That may seem crazy, but I have seen a situation where they were selling something to which they didn't have complete ownership rights. Also, is the target company free of contractual or legal obstacles? I mean, are there any lawsuits, for instance? We might do a management due diligence as well, which is definitely recommended. So what is the management structure and who's actually running the company? You also need to check on integrity. So what was the past performance like? How was the management over time? Who are the key people? And obviously you want to protect yourself against illegal activities like money laundering, fraud, and various other abuses and potentially criminal activities. From a cultural point of view, you might want to understand the leadership style that's in the target company. Is it top-down, command and control, or is it more family-based, for instance? What is the corporate behaviour as a whole? What are their attitudes and beliefs over time? Because, of course, you're going to need to somehow integrate those with the culture in your own company, and you want to try and avoid culture clash. From a practical point of view, it's good to use a range of experts as they have different perspectives and different competencies. And it's not just about the written down, codified data, but also interviewing target management team and stakeholders. And obviously you need to try and coordinate all the information so you get a well-rounded view of the target company, and that's a demanding and difficult task. One potential problem for the acquirer is becoming overloaded with the quantity of information rather than the quality, and in some cases target companies will actually try to blind you with the volume of due diligence material in order to try and hide or conceal potentially negative information, and you need to guard against that. And due diligence is expensive and exhausting, and here on the slide I give you an example of the Shell oil company and how much it took them, both in terms of time and money, to prepare for due diligence. For the target company, due diligence generally does not work to its advantage. It's disrupting their business, it destabilizes the firm, and of course the acquirer will probably use it as a mechanism for reducing value. If you want to try and reduce those negative aspects, then really try to conduct due diligence relatively quickly. Sometimes these days data is provided online, which might give you easier and quicker access. And you can cut some corners by using representations and warranties. But be careful, just because things have representations and warranties, it still leaves room for mistakes and errors, and this is not a perfect remedy for not doing due diligence properly. One of the main problems, though, about due diligence is it can separate the exercise, the due diligence exercise, both from the strategy, why we're doing the acquisition, and post-acquisition management, which is about how do we gain value afterwards. If you're not careful, it becomes a generic exercise where accountants simply look at accounts, lawyers look at legal statements, and somehow hope that it fits with strategy and integration. And often that's not the case. So what can be done to improve due diligence? And if you remember, this is about overcoming information asymmetry, the fact that you don't know as much about the target as you really want to get an accurate valuation. And here we can look at the fact that classical due diligence is really quite narrow in its scope. Normally it's about investigating a particular target and then helping in the negotiations and getting into detail. Now, there's an argument for saying that due diligence should have a broader scope. I don't mean across different functional areas like operations, management and culture, but I mean a broader scope in terms of time, coming in slightly earlier into the process and also extending into the post-acquisition phase. So at the bottom of the picture, we have our strategic due diligence, and one possible thing you can do earlier in the process of getting into acquisition is to take a prior equity stake. Now, the American company Cisco Systems is well renowned for doing this, but by no means are they alone. So companies like Google, for instance, do this as well, where they look for a company, perhaps an entrepreneur, who they think has a promising product or technology that they may wish to buy in the future. So what they do is they take a prior equity stake, say 25%, sometimes called a minority acquisition, in order to get inside information about the real quality of the company and the product. And if it improves over time, then they're in the best position to make an acquisition bid later on. Now, of course, it's not perfect, because as soon as you take your equity stake, you're essentially going to be driving the share price up of that target company, thus making it more expensive for yourself. However, you could argue that it does reduce the risk of acquisition, and this is a price that Cisco thinks is worth paying. Closer to the actual negotiation period and contract signing, people using strategic due diligence might also employ clean teams. Now, these are basically experts that are put into the target company in order to find out exactly what things are like in terms of, say, operations or systems and IT and so on. Now, these clean teams may be consultants that have been hired by the acquirer to go in and get a full understanding of the target company and produce a plan for successful integration. However, as the acquirer has not yet purchased the target company, the consultants are not allowed to communicate any of their results to the acquirer. So essentially, the acquirer is paying their fees but can't get access to the results unless the deal is completed. Of course, if the deal is completed, then they immediately have an action plan which is based on high quality data, and it should help integration. However, if the deal does not happen, then essentially you've thrown your money away because you can never have access to that information. Another type of clean team is where the acquirer decides to send one or two of its key employees into the target company. Obviously, this has to be agreed with the target, and again with the same purpose, to fully understand the target and to work out a very detailed integration plan. If the deal goes ahead, this saves a lot of time and money and allows better integration. But of course, if for any reason the deal does not go ahead, then you've just lost your key employees. So neither of these approaches is perfect by any means, and will only work if you have an extremely high sense of probability that the deal will happen. Other things you can do are to retain the top management and the key employees in the target company. And the way to do that, of course, is to incentivize them, perhaps by offering shares in the acquiring company, or to offer them some cash payments over time in the future. You might even use something like an earn-out, which is related to post-acquisition profitability. What this can do is keep those top management employees in position and incentivized to do a good job. One of the risks of this approach, however, of the earn-out, is you might get them engaging in negative behaviours in order to get their bonus, if you like, for staying. So, for instance, if you're trying to incentivize the CEO of the target company and say, please stay on, and if you increase sales by 10%, we'll pay you 15% more cash as salary, or give you more shares, then it's likely they may well simply do everything to increase the sales, but they might also be pulling investment out of other areas to subsidize that, or to enable them to get their bonus rather than doing what's best for the business. So earn-outs as a mechanism doesn't always work, and it can be a double-edged sword. Another type of protection, if you like, is the payment type. Clearly, if you pay the management team of the target company in shares, in the acquirer's shares, then they have an incentive not to damage or potentially damage the post-acquisition performance, because the value of their shares would go down. So you're trying to incentivize them through tying them into your own shares. They're sharing your risk, if you like, of integration. However, with cash, the danger is they will simply take the money and run. So here then you can actually defer the cash payment, as I discussed earlier. And then finally, you can also do a post-closure audit, which basically says that once you've bought the company, you engage in a due diligence audit afterwards to find out what you actually bought. Whilst this takes time and effort, at least you know the problems early on rather than waiting for problems to emerge. As I said, there'll always be something that hasn't been revealed or discovered. And then the final part of strategic due diligence is some form of performance evaluation which allows learning afterwards. It's very surprising that very large numbers of companies never do carry out some sort of performance evaluation. It could be, of course, that chief executives often do these deals and nobody particularly wants to criticise their top management team for things not having worked as well as perhaps was expected. So this slide compares classical with strategic due diligence in terms of focus, key questions, areas for investigation, main participants, information sources and scope. And I don't think I'll go through it. I think you can read it. But essentially you can see that strategic due diligence has a broader scope, it has broader concerns, it uses more participants, it tends to have wider information sources, and it's longer in terms of engagement with the process. And of course, it's also more expensive, which is possibly why it's not quite as attractive as it sounds. There are many surveys that identify the root causes of deal disappointments. This is one from Bain, which is a consultancy, in 2002, but there are dozens of these. And if you look at the chart, you'll see that 70% or 67% of respondents cite ignored potential integration challenges, which suggests, of course, that you should have thought about those before you did the deal. And above that, overestimating synergies. And then above this, problems of integrating management teams. And then at 50%, they say due diligence failed to highlight key issues. But where I've put the arrows on the left-hand side, I would argue that all of these are critical to doing a good due diligence, such as potential integration challenges and synergies. So I interpret this as to say, probably they've used rather too narrow due diligence and they've probably done it under too high a time pressure. And that's why these other areas have been very problematic. So in summary, due diligence is a critical part of the M&A process. It aims to reduce the risk of the transaction, and it does that by improving the knowledge of the target business. There is an assumption that better knowledge will help, and that you can avoid black holes, that's the very large areas of liability, and that it can help you in post-acquisition planning. Due diligence is often not done as effectively as it could be, and that's down to time pressure and lack of scope, both in terms of breadth and time. And I think strategic due diligence, or thinking more strategically about it, can improve the due diligence process. So to summarise where we've got to, we've looked at deal formulation, transaction, post-acquisition management and post-acquisition performance. And in the deal formulation stage, it's all about identifying value potential. And the key here is really strategic fit in terms of, are you moving into new markets? Are you vertically integrating? Is there concentric diversification? We're thinking here about what's the synergy potential. And then we have the transaction where there are lots of integration constraints. And then in the post-acquisition period, we're looking at integration constraints in terms of organisational fit. So can we put the cultures together? Are the organisational structures compatible? Can the managerial practices work together? These all matter in terms of getting between the value potential and the ultimate realised value. And of course, right at the bottom, we have acquirer's experience. It may be a bit of experience helps. And of course, the external factors that the world changes, and that can adjust things that were previously planned for. So throughout this lecture, I've been suggesting that there is a risk in focusing too much on just doing the deal and not thinking about the integration in enough detail. And these are some examples. I won't go through them all. I'll just pick a few. So the first one is about due diligence just getting codified or written down information and thinking that this is everything you need to know. So in the example, where is the formula about a soft drinks acquisition, an American company decided to buy a UK soft drinks manufacturer, fizzy drink manufacturer. And on the first day of ownership, the American managing director came over to the UK to see the factory and found it wasn't working. And that's very, very expensive in manufacturing terms. He asked the employees, why is the factory not working? And they said it's because we don't have the formula to make the drinks. Of course, he was angry at this and said, well, surely we must have purchased the intellectual property of this company. And his advisors assured him that was true. So he said, well, where is the formula? And the employee said, well, it's in an industrial-sized safe, large metal strong room where things of value are kept. He said, well, why don't you open the safe? And they said, well, we don't have the combination. And it turns out that the American company had decided to reduce the headcount and got rid of quite a few people to save money. And they tended to concentrate on lower value staff and one or two middle managers. And it's these people that actually had the combination to the safe. So they couldn't get the formula for a few days. When they eventually opened the safe, they discovered that the formula wasn't there. So again, he said, where is the formula? And it seems that the people that had been fired had destroyed the formula because they were so angry at losing their jobs. The next example is on focusing on grand strategy and ignoring implementation. So I'll use the third example here about the suppliers contaminated. This is about a water company that bought a nearby water company. Again, they'd done the due diligence in looking at the legal issues and the accounting issues. And then on the first day of ownership, the managing director of the acquirer went over to have a look at the company that they'd just purchased. Now, it's important to notice that at this time, there was a lot of criticism in the media about the quality of water the water companies were providing. And they were being heavily attacked by the media and the regulators. So as the managing director approached in his car the other water company, he could see lots of white things floating in the reservoir containing millions and millions of gallons of water. At first he thought they were perhaps leisure buoys where people had boats tied up to them and they could sail on the reservoir. But as he got closer, he could see that was not the case. And then when he eventually arrived, he realised that in fact they were dead sheep that had fallen off the hillside because no one had actually been maintaining the fencing around the reservoir. Of course, this is polluting to the water, and the water was the main drinking water for nearby towns. If the media had heard about that, it would have been a disaster for this company. But the question is, the most important asset when you buy a water company surely is the quality of the water. So why had this not been checked in the due diligence? And the simple reason is you can't see it in the accounts and the numeric data. There are many examples of due diligence disasters. Rover BMW I've talked about. Daimler Chrysler was a disaster. Compaq and Digital, HP and Autonomy, and so on. So in summary, the M&A process, it matters. And the key issue here is information asymmetry, because you just cannot know everything about something you're about to buy. But due diligence is a very important aid to reducing information asymmetry, but it's not perfect because it's often time constrained, and although clean teams can help, it tends to be under limited circumstances. However, it's not just about the due diligence. The main problem, I think, in the process is focusing too much on doing the deal and not paying enough attention to what happens next. And that, of course, is the post-acquisition integration phase.